All right, let's talk about something that's a total game changer for Canadian businesses, getting the equipment you need to actually grow. We're going to open up the playbook right here, right now, to show you exactly how to get it done.
You know the feeling, right? You've got your eye on that one piece of equipment, that one truck, that new machine that you know will take your business to the next level. But then you see the price tag and, well, the cash just isn't there.
Yeah, it's what we call the classic business growth paradox. It is a total catch-22, isn't it? You need the gear to make the money, but you need the money to get the gear. It can feel like you're just stuck running in circles.
Well, that is exactly what this is all about. This right here, this is your playbook. We are going to show you exactly how to break out of that loop and get funded.
Okay, let's dive right in. First up, understanding your options. This is the first play in the book, and it's all about the big choices you'll face right at the start.
So, what is equipment financing? It's actually pretty simple. It's a loan or a lease where the equipment you're buying is the collateral. That's the secret sauce. It means you get the gear now, pay for it over a few years, and you don't have to drain your bank account. That cash stays free for other critical things, like payroll or buying materials.
Okay, so your first major fork in the road is deciding on the lease type. You've basically got two choices. A capital lease, think of that as a lease-to-own deal. You make all the payments, and at the end, boom, the equipment is all yours. Then you have an operating lease, which is way more like renting a car. You use it for a while, and then you just give it back. This is perfect for stuff that gets old fast, like tech, because you can just upgrade to the newest model.
All right, section 2. Now that you know what you're looking for, let's talk about where to get the money. We're going to size up the main players, and trust me, they are definitely not all created equal. So, you've got 3 main doors to knock on. First, the big traditional banks. Sure, they might have good interest rates, but man, can they be slow and picky. Then there's the BDC, the Business Development Bank of Canada. They can be an awesome partner, but get ready for a mountain of paperwork. And finally, you've got the specialists, the brokers and leasing companies. This is all they do all day long, so they're connected, they're fast, and they're usually your most flexible option.
And hey, you don't have to take my word for it. This quote from a real business owner on Reddit says it all. The bank gave them the complete runaround, hoops to jump through, and then nothing. But the specialist lender, they got them a same-day approval. That right there shows you the massive difference that speed and focus can make.
Okay, let's get into the nitty-gritty. Section 3, the lender's approval pillars. Think of this as learning the rules of the game. If you want to win and get that approval, you got to know how the lender is keeping score. And it really all boils down to 3 key things. And here they are, the 3 big pillars of approval: credit, cash flow, and collateral. Every single lender, no matter who they are, is going to look at your application through these 3 lenses. So let's break them down one by one. Pillar number 1, credit. And we're talking about your personal credit score here. The magic number is usually somewhere north of 600, maybe 650 just to be safe. Now, can you get approved with a lower score? Sometimes, yeah, with some of those specialized lenders. But a stronger score? That's your ticket to a better interest rate almost every single time. Next up, and this one is absolutely crucial, is cash flow. Lenders have to see that you've got enough money coming in every month to comfortably, easily make that new payment. This is exactly why they want to see your bank statements. They're just confirming that your revenue is steady and reliable. And pillar number 3 is collateral. This is all about what the equipment itself is actually worth. Lenders look at something called the loan-to-value ratio, or LTV. Basically, as you can see here, they'll usually finance somewhere between 50 and 80% of the asset's value. That little gap that's left over, that's your down payment. It's how the lender minimizes their risk. All right, part 4. Let's build your winning application package. This is your game plan. A killer application isn't about throwing a mountain of paper at the lender. It's about giving them exactly what they need to say yes. And look, don't let the idea of paperwork freak you out. The whole thing, the entire process, just boils down to the lender needing to confirm 3 very basic things.
It really is this simple. They just want to know, 1, who are you? You prove that with your ID. 2, how do you make money? That's what your bank statements show them. And 3, what are you trying to buy? That's the quote or invoice for the equipment. That's it.
So here it is, your essential checklist. For most deals, this is the whole shebang. You're going to need the credit application, a piece of government ID, your last 3 to 6 months of bank statements, that equipment quote, and just a quick little paragraph about what your business actually does. Get those things together and you are golden. Okay, last section, and this one might be the most important. We're talking pro tips and common traps. Think of this as your secret weapon, the insider knowledge that can save you a ton of headaches and maybe even save your deal.
So let me ask you a question. Do you think being too helpful, providing more documents than what a lender asks for, can actually get your loan application denied? It sounds crazy, right? But the answer is a definite yes.
And here's why. This is so important. Once you give a document to an underwriter, they legally cannot unsee it. They have to review it. So let's say they ask for 3 months of bank statements, but you send 6 because you want to be helpful. Well, what if there was one weird transaction in month 4? You've just opened a can of worms and created a problem that didn't even need to exist. It could kill a perfectly good deal.
So, let's wrap this up with the biggest traps to avoid. Number 1, don't overshare your documents. Just give them what they ask for, nothing more. 2, and this is a big one, never ever send an inspection report unless they demand it. It just gives them a list of tiny problems to worry about. And finally, be prepared. Factor in things like downtime for installation or training costs, and for goodness sake, know your own numbers inside and out.
And there you have it. That's the playbook for getting the equipment financing you need in Canada. You understand the options, you know who the players are, and you know the rules of the game. You're ready. So, the only question left is, what's your next move?